Do y'all record these?
Yeah,
Oh,
so
cool.
I started recording there.
Oh,
And
good.
then this one will be recorded.
Oh, fun.
So. Andrew, get on. Oh, there he is. Where are you?
I could let people in on that also.
Yeah, okay, it's 9. Let's go. Ready? Andrew, you're on mute.
All right, everybody. Good morning. This is Andrew Cole with East Orlando Chamber of Commerce, and we're here with a great presentation on healthcare, on health insurance. It's the American Rescue Plan. I've got Craig Rodrigue with CSR and Associates. But before we start, I do want to make a couple pleasantries real quick. We have, I want to say thank you to PowersNet, who is a full-service IT firm that specializes in data security, monthly managed service, and contact center solutions. They can help you with a single project, or they can function as your IT staff, or anything in between. So we want to say thank you to PowerNet for powering our webinars and live videos that we do for the Chamber. I also want to say a few quick shout outs to our trustees: Advent Health, Avalon Park Group, Avalon Insurance Services of Hunters Creek and also Lake Nona, Duke Energy, Great Florida Insurance, I twisted that one up, Great Florida Insurance of Hunters Creek and Lake Nona, sorry about that, Avalon Insurance Services, the Orlando Law Group, Orlando Health, and Suburban Land Reserve. So we really appreciate our trustees. And without further ado, I want to introduce Craig. So Craig, welcome today.
Good morning.
Good morning.
Thanks so much for having me.
Some great information we'd like to hear from you. So I'm going to let you take it from here, introduce yourself a little bit more, and tell everybody what we're going to hear from you today. And we're going to do this also. If you have any questions as you log in, you can feel free to put them in the chat box. If you're watching Facebook Live, feel free to type them in, and we will address those at the end of the presentation here, just to ensure that your questions might get answered through the rest. So Craig, take it away. Thank you so much for being here.
Thank you, Andrew. I really appreciate it. And I appreciate the East Orlando Chamber giving us a chance to have this conversation. We're going to cover some really valuable information. We're going to do it pretty quick. If you have questions, please let us know. I want to start with one thing that's not actually in the slideshow. We're going to talk about the No Surprises Act real quick. The No Surprises Act started in January. It's going to take effect January of 2022. And what that's trying to do is trying to stop surprise billing. A lot of us don't realize that I had a client that had a heart attack. He goes to the emergency room in the in-network hospital. You would think that you're in-network at that point. Well, what we don't realize is hospitals don't run their emergency room. They lease their emergency room out, maybe to Craig's Emergency Room Service. So in this case, he goes to the emergency room. He gets treated at an in-network hospital. The emergency room starts billing him as an out-of-network service, as if he wasn't in an in-network hospital. So what the No Surprises Act is trying to do is stop that kind of practice from happening in emergency rooms, air ambulances. And so you'll see some transition there. There are also going to be some pricing transparency things that are going to happen on the 300 most shoppable services, where you'll be able to go online, search the cost of services, and see what that'll cost you at Dr. Smith versus Dr. Jones, and compare services before you do them. So the No Surprises Act, look for that to start happening in January of 22. One other thing I want to talk about was an executive order that got signed this year since President Biden's taken office. And that revolves around a medication called PrEP. What is PrEP? PrEP is a medication that you would take if you were concerned about catching HIV. It's about 95% effective at stopping you from catching HIV. Pretty effective medication. The problem is it's about $2,000 a month, which makes it not very affordable for anyone. What this new executive order is going to do is cause PrEP to be covered at 100% like a preventative care service, like a pap smear or a mammogram or birth control pills. If you know someone that's concerned about that medication or they take that medication, almost all health plans are going to start covering that for free. That really brings us to the presentation we want to have today, and that is the American Rescue Plan. A lot of people are familiar with the American Rescue Plan because they were going to get a $1,400 check. Well, this was a $1.9 trillion piece of legislation, or bailout bill, if you want to call it that. The $1,400 only accounted for about $410 billion of the $1.9 trillion. The question then is, what happened to the rest of the money? Well, here's the good news. I'm not going to tell you what happened to all the rest of the money, but we are going to talk about what happened to some of it. $50 billion went to fund coronavirus testing, increase the size of public health workforce, funding vaccine distributions and supply chains. We're all familiar with the $1,400. There was a 4% reduction in Medicare pay-go. So if you're on Medicare, Medicare is going to pay the doctors 4% less than they used to. That's part of how they're coming up with some money. We really want to spend time on 4 things that I think you need to know. The first one is a change in COBRA. I want to understand COBRA law so that we know what this change was. So last year during the pandemic, Andrew worked for me. I had to lay Andrew off. How does this work? I had 45 days to notify Andrew that he was eligible for COBRA. Andrew had 60 days to elect, and if he took the COBRA, he owed premium back to date of termination. Well, in the pandemic last year, I had to lay Andrew off. The world shut down. I asked Andrew if he wanted COBRA. He said no. He didn't have a job. He didn't know if he was going to get a job. He never took my COBRA. What the American Rescue Plan says is I'm now required to make a new COBRA offer to Andrew, starting April 1st, running through the end of September. And for Andrew and his family, or whoever was covered on his group health insurance, it's going to be free. And he does not have to pay any of the back premium for the amount of time that he's been gone from my company. It could have been any time in the last year he's been gone. He hasn't been on COBRA. I haven't talked to him. I've got to make this new COBRA offer. Hey, Andrew, would you like COBRA? COBRA is going to be free, and it goes through the end of September. Free is a big word because we know it's not free, so who has to pay for it? The employers have to pay for the COBRA, and then they're supposed to take that COBRA premium out of the federal piece of their payroll taxes, the FICA that they would pay out of their payroll taxes. Well, that's pretty tough because a lot of companies laid off maybe 50% of their employees. They're now supposed to pay for 50% of the people to have COBRA and take it out of 50% of the people's payroll taxes. This could be a burden on the businesses. What you need to know as an employer is if you've been COBRA eligible, you had more than 20 employees, and you've been offering COBRA to employees, you only have until the end of the month to make this COBRA offer. So make sure you're getting the information that you need. The next one is a premium tax holiday. Here's how this works. Andrew needed an individual health plan. I said, Andrew, how much do you think you're going to make? He says, I think I'm going to make $20,000. I say, great, Andrew, you qualify for $1,000 a month in subsidies from the federal government to help you buy health insurance. At the end of the year last year, Andrew sat down with the accountant. The accountant said, how did it go? Andrew said, went great. I didn't make $20,000. I made $40,000. And the accountant says, well, you shouldn't have gotten $1,000 a month in subsidies. You should have gotten $500 a month in subsidies. Andrew owes $6,000 back to the federal government. Except he doesn't. For 2020, they're saying if you made more money than you thought you were going to make, you don't owe any of that tax credit back or any of that subsidy back to the government. The problem was they didn't pass this law until about the end of March, and most people had already done their tax returns. We thought you were going to have to file an amended return in order to get that refund. The IRS has now said they're just going to mail you a check. So look for your refund to come soon. The third one on this slide is very interesting. I'm married and my wife is Laura, and Laura had a job and she got laid off. And she's received at least one unemployment check in 2021. Because she received one unemployment check, my entire family qualifies for the maximum allowable subsidy on healthcare.gov, i.e. free insurance. because she got one unemployment check. So if you're a family out there, someone in your family's received an unemployment check, make sure you give us a call and figure that out. If you've ever heard me talk about healthcare, you know that it always starts with this slide. What we're looking at here is across the top is number of people in your family. Subsidies were available between 100 and 400% of federal poverty level. What did that mean in English? It meant a single person could earn up to about $51,000 a year and still qualify for a subsidy. Family of four can make up to about $104,000 a year and still qualify for a subsidy on the exchange. We're going to look at three people and see what's happened according to the American Rescue Plan. The first one is my buddy Dave. He's a family of four. He made $52,000 last year. He's at 200% of federal poverty level. Show you why that matters in a minute. Me, I'm having to read tax law and legislation all the time. So I made about $17,000 last year. I'm at 138% of poverty level. The last one we're going to look at is a married couple making $103,000 a year, and they're at 600% of federal poverty level. The reason why it matters is the column on the left, depending on the percent of poverty level you're at, that determines what percent of your income you pay for your health insurance. Dave was at 200% of poverty level, so he's going to pay 6.5% of his income for his health insurance. We look at the bottom of the slide in black, 52,400 times 6.5 divided by 12. David could insure his entire family for $284 a month. When I'm asked if anybody benefits from healthcare reform, David's benefiting big time. Except this middle column are the old numbers. The American Rescue Plan has established the column on the far right. See, now Dave's at 200% of poverty level. He only pays 2% of his income for his health insurance. 52,000 times 2% divided by 12, David can insure his entire family for $87 a month. It's a huge benefit for him. What happened to me? I was at 138% of poverty level. I was going to pay 3.1%. Now I'm going to pay nothing. So we can look at the bottom of the slide there and see I'm going from $45 to zero premium for my coverage. Now, Craig and Dave have one of two choices. See, they could call me on the phone today. We could redo their application and their premium would change right away. Or maybe in Dave's case, Dave never calls me or he doesn't hear about this and he gets to the end of the year and he files his tax return, he'll get a refund of $200 a month or $2,400 right on his tax return. The third person is Eric, and Eric's the reason I'm standing in this room today. See, Eric is married. They're both 60 years old. Eric made $103,000. Under the old rules, Eric's not eligible for a subsidy on healthcare.gov, so they were paying full premium. A real quote for them would be about $1,979 a month. Now, the American Rescue Plan has said, hey, we guarantee that you won't pay more than 8.5% of your income for your health insurance. So now 103,000 times 8.5 divided by 12, Eric can now insure him and his wife for $732 a month. Eric qualifies for $1,247 a month in subsidies from the federal government to help him buy his health insurance. Here's the problem Eric has. Unlike Craig and Dave, who if they do nothing, they get a refund at the end of the year of the amount of money they should not have paid, that's not true with Eric. Eric doesn't get that $1,247 until he does the application. If it takes him 4 months to hear that he should have called me and redid his application, that's $5,000 gone in Eric's life and he never gets it back. It's just gone. So for these people that have not been receiving the subsidy, the money is huge. That's $15,000 a year in subsidies that Eric is now eligible for. It's a massive amount of money. Let's say Eric made $150,000 a year. Say he made a lot of money. Well, 150,000 times 8.5 divided by 12 is $1,065 a month that he would pay for his health insurance. Now you might say, hey, Craig, $1,065 a month, that's a lot of money. Well, it is a lot of money, but it's nothing compared to the $1,900 that he's paying today. So he would still receive $900 a month in subsidies, $10,000 a year in subsidies to help him buy health insurance. This is a life-changing event for people that are in this category. If we're more realistic and we say Eric's family makes $75,000 a year, times 8.5% divided by 12 is like $535 a month that he would pay instead of the $1,900 a month he's having to pay today. This is a big deal. Now, the question everybody always wants to know is, yeah, Craig, but what kind of coverage do I get? There's 4 kinds of plans available on the exchange: bronze, silver, gold, platinum. Subsidy is based on a silver level plan. So to give you some perspective, 30 for the doctor, 60 for the specialist, maybe a $3,000 deductible. So good coverage. I enter David, I enter his wife, I enter his kids. I come back to David and I say, your plan cost $1,087 a month. David says, wait a second, you told me I was going to pay $87. That's right, David. That means you get $1,000 subsidy to help you buy your health insurance. Once we've established the $1,000, David can move up or down this chart however he wants. If he said, hey, Craig, I can't afford the silver, how much is the bronze plan? Bronze is $900. And David's got $1,000 subsidy, so he's going to pay nothing to have the bronze plan. And to give you some perspective, for him, the bronze is going to be a much better plan than the silver would be. Maybe 50 for the doctor, 75 for the specialist, 0 deductible. Everything is a copay. So emergency room, $1,300. Outpatient surgery might be $1,300. An x-ray might be $100. Lab work, $50. So much better coverage. He might say, well, gosh, I want great coverage. How much is the gold? Gold's $1,400. David's got $1,000 subsidy. He pays nothing to insure his entire family. Now, there's one more thing we need to cover here. David's really lucky. Because David's under 200% of federal poverty level, he qualifies for a second benefit called cost share. What cost share does for David is it lowers the deductible, lowers the copay, lowers the max out of pocket. To give you some perspective, we literally have clients that pay 70 cents a month in premium, is $1 for the doctor, $3 for the specialist, 0 deductible, $500 max out of pocket. Better than anything you can get with any amount of money out of your pocket. Unbelievable. Now, there's one more thing you need to know about us is we do backwards math. We don't do forwards math. What do you mean by backwards math, Craig? Well, we're all used to forwards math. How much for me? It's $200. What if I'm my wife? It's another $200. What if I'm my kids? It's another $200. My math doesn't work that way. David calls me up on the phone. He says, hey, Craig, I'd like to get some health insurance. Great, David. How much do you make? I make $40,000 a year. That puts David at 300% of federal poverty level. 300% of federal poverty level, David's now going to pay 6% of his income for his health insurance. 40,000 times 0.06 divided by 12. I say, great, David, I can insure you for $200 a month. David says, hey, wait, I forgot about them 2 kids. Oh, see, now David's a family of 3 making 40,000. He's at 200% of poverty level. 200% of poverty level, he's going to pay 2% of his income. 40,000 times 2 is 800 divided by 12 is like $73 a month. I say, hey, David, I'll insure you and the kids for $73 a month instead of just you for $200 a month, because we do backwards math. More people cost less than less people. If David then says, hey, wait, I got a wife too. Now he's a family of 4 making $40,000. He's at 150% of poverty level. 150% of poverty level, he pays nothing to insure his entire family. The premium would be zero. This is probably a good place for me to stop, see if anybody has any questions. I don't know if any have come in. Doesn't look like they have. So I tell you what, you can always feel free to give us a call in the office if you have questions about how some of this works. You can reach me at 407-937-2900. If you know someone that you think some of these items might apply to, if you're an employer that's required to do the free COBRA and you have questions about that, we can help with that. If you've received an unemployment check, you want to know how that works, give us a call. On the subsidies, any of this information that we've covered today, I'd be happy to help you out with that.
We had a few people that had jumped in, so if there's any questions, you can either, if you want to unmute, you're welcome to, or type them into the chat box with what's here. One of my questions, just kind of going, is if somebody's getting, and I guess it would all depend on what plan you have through your employer, but just kind of looking at that as, you know, because the employer may pay for part of that plan if they offer it. So like if I worked for a large company, how does that factor in? If I can ask the question, if I worked for a large company that offered insurance to me or to my spouse or whichever it would be, how does that work or figure in to compare what you're paying or what the government is subsidizing here?
Great question, Andrew. So here's how this works. Andrew works for Craig. Andrew gets paid $20,000 a year. What we have to figure out is Andrew offered a qualified plan that's deemed affordable. What deemed affordable means is he doesn't pay more than 9.8% of his income for employee-only coverage. 9% of $20,000 is $1,800. Divided by 12 is $160 a month. So if I offer Andrew coverage for just him at less than $160 a month, then neither Andrew nor his children are eligible for a subsidy on healthcare.gov, but Andrew's wife would be. So we'd go back to the same thing. How many people in your family? 4. What's your total household income? 30,000. So now Andrew's wife would get coverage for free. Andrew would have to take the coverage at work at $150 a month. Now, if that employer offered Andrew coverage and it was more than $160 a month, let's say $170 a month, then Andrew and his entire family would be eligible for a subsidy on healthcare.gov. So we have to kind of figure out what the offer they've made to you is.
I'm trying to think of a follow-up question to it, and I'm still mulling that over. So I'm just trying to figure out. So if you have, let's just say you have 2 well-paid employees that are offered insurance through their employer that are over that 100. Let's just say you've got a family of 3 making $105,000. You do the same math for that, and then you could compare it to what you're paying through your employer if they were both offered 50%, or one of the spouses was creating that, and then you can see whether, is that how you would compare it to
Yes.
see how that would work?
So actually the Facebook people want me to repeat the question. So the question Andrew has is, what if Andrew has a job and the wife has a job? Then we have to actually do that calculation for both of you to determine if either one of you could go to the exchange. A couple of interesting things happen in this whole scenario. You know, number one, we got to figure out, is Andrew working for a large employer or a small employer? Large employers are required to do reporting, so they're definitely going to report you. And so we want to make sure we're following the law there. And large employers, you guys got to realize it got confusing. When President Trump eliminated the individual mandate, and what the individual mandate was, is Craig has a requirement to own health insurance or pay a penalty. Well, President Trump eliminated that, and he set that penalty to 0. That made a lot of large employers with more than 50 employees confused, because they thought the large employer mandate had been eliminated as well. It's not been eliminated. Large employers have a mandate to offer coverage that's deemed affordable. If you have more than 50 employees, you have a mandate. Now, some people say, yeah, Craig, but I got a Dunkin' Donuts with 30 people and I got a Krispy Kreme with 25 people. Neither one of them has more than 50 employees, so I don't have a mandate. That's not actually true. There's common ownership rules that say if 51% of the ownership is the same in any two businesses, they stick them together and there's a mandate for you to offer coverage. This is going to be hard because the last administration was not going after employers. The new administration is absolutely going after employers. I just had an employer receive a penalty letter from January and February of 2016, 5 years ago, and they now owe $10,000. This is a person that I had met like in December. We got coverage offered for them by March, but they had 2 months they didn't owe coverage. They're paying a $10,000 penalty just for those 2 months. If you're a large employer, you need to offer coverage. The large employers say, but I can't offer coverage. You know, I just did a policy for a roofer. The roofer had 85 employees. He perceived that 85 people were going to enroll in the health insurance and he was going to pay this huge amount of money for 85 people. What normally happens is we offered to 85 people, 7 people enrolled in the health insurance. So he is paying a portion of the premium on 7 people, but his mandate is to offer. I got to offer Andrew coverage at $150. It doesn't matter whether Andrew takes it or not. My mandate as the employer is to offer. And as long as I've met that, I don't owe a penalty. So in this case, you know, 7 people enrolled, 3 of them were him and his mother and father that worked in the company. So he ended up paying for insurance for 4 people he wasn't paying for insurance for anyway. If you're a large employer, you need to do this. And if you're a large employer and the agents you've been talking to are telling you that it can't be done, please call me. And I don't say that just because I want to write the business. I'm telling you, I will get it done. I've written 3 companies in the last couple of months that other agents, PEOs, employee leasing, all kept telling them they couldn't do it because it didn't meet participation. We can get that done and save you what would be on 100 people. That penalty is $3,000 per person for every employee you have past 30. 3 times 7 is $210,000 penalty. After tax, not tax deductible. This money is not a joke. It's put you out of business money. So please, if you're in that category, call me and let's clarify those rules.
Another question that just to bring in on the COBRA piece, going back to where we were at the beginning, just kind of leading into that, that is, you know, if that is an employer that has to offer insurance would then offer the COBRA. If a company is under that 50 lives and doesn't have insurance for their employees, they do not have to offer COBRA, correct?
Correct. So to be COBRA eligible, you have to work for a company that has more than 20 employees. So the question is, how does a company know whether they have to give the free COBRA away or not? If you have more than 20 employees and you have health insurance in force, you've been doing COBRA anyway. So if you've been offering COBRA to employees when they left, then your mandate is to make a new offer to anyone that you laid off or fired. The only exception would be if Andrew quit or if it was gross negligence. If I fired him for gross negligence, I don't have to make that offer. But the attorneys will tell you gross negligence is very hard to prove. It's much more than he showed up later, he didn't do his job, so I let him go. It's going to have to be something pretty severe on gross negligence. So anybody you fired, anybody you laid off, you need to make that offer to them. If he quit, I don't have to make the offer, assuming you've kept all those records.
Okay. Any other questions? And Dorothy, you can let us know if there's any other questions from the Facebook followers there.
We don't have any other questions there. And we've covered a lot of what we need to cover, Andrew. I want to encourage people. I understand you're recording this. Please share this information. This is a lot bigger deal than just, hey, call me. This is stuff that'll change people's lives. There's a lot of people out there that have made too much money in their businesses and not been getting subsidies. And you come and hand them $10,000 or $15,000 a year. That's a life-changing event for them. So if you have any other questions, please let me know. Give me a call in the office. Like I said, my number is 407-937-2900. And I want to tell the chamber, thank you very much for giving me this time and giving us an opportunity to share this.
Well, we appreciate you here, Craig. Like I said, this information will be saved, and it'll be on Facebook where you can find it there too. So if anybody that you know that needs some of this information, they can kind of review this, and once again, reach out to Craig for any questions on any of the healthcare reform with this new subsidy calculator and how to figure out if there's a way to take care of that for you and your family, and if it's one of your interests that you'd like to have in that. So Craig, thank you for your time this morning. I'm not seeing any other
I really appreciate it.
questions. So without further ado, everybody have a wonderful rest of your day. Thank you for the great information here, and we will see you soon.
All right. Thank you. Bye-bye. All right. We did it. And I don't even think I stumbled that much. Joe McQuaid. That's a cool name.